Tyler, it's a new year. That means it's time for us to talk about some of our favorite stocks right now.
It's an annual tradition. Beginning of the year, time to talk new stocks.
Love it.
New ideas, new me, new you. Everything's new.
So Tyler's lying, and this is a new month. It is a new year, but we're going to be talking about some of our favorite stocks that we've talked about before, but we really like them right now. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. Go to fool.com/unscripted. Motley Fool's got some great stocks too for you. Fool.com/unscripted. The Motley Fool is going to give you its 10 best stocks to buy right now. Tyler, 2023 was a great year. The market went up by double digits. Tech stocks, you did even better. But even microcaps and small caps did well. Some oil and gas stocks did okay. Oil prices are down a little bit though, and the market's starting to get down on oil prices. And I know that's got you particularly interested in an area of the oil and gas market that's done well and you think has good prospects going forward, but the market's maybe a little down right now.
Look, man, whenever the oil market goes down, you call me up, be like, hey, because he must be excited about oil stuff because oil's cheap right now. So yes, one of the things that I have been noticing a lot lately is that there has been some concerns that there's a little bit of weakness in the oil market. We just saw a recent thing where the Saudi Arabia cut some of its delivery prices, suggesting maybe there's some weakness in Asia in terms of total demand. Oil production in the United States is still going relatively strong. So there's a lot of reasons to think that oil might not be headed for the moon or anything like that, or into the triple digits that people might be feared about that they are. However, it's not that the industry is unprofitable right now, even at where current rates. I think it's $70 to $75 range, somewhere in there.
In the
now,
low to mid 70s right now for the major benchmarks.
a lot of companies in this industry are still immensely profitable, and there are a lot of ignored companies. I think everyone seems to head for Exxon and Chevron, which is fine. They're very quality businesses, but you have to pay a premium because of that. But there's a lot of kind of the oil services, refiners, maybe some of the companies that aren't as much of the household names for a lot of people that are still trading at very attractive valuations. And with the relative health of the industry in both the services and refining, especially in North America, I think there's still some opportunities here for people who really want to dig deep into the market. Now, Jason told me to rein it in a little bit, keep it to the American market, and don't go diving into micro caps. I'm going to give actually a basket of 3 companies that are relatively attractive to me right now in the oil patch. One of them is HF Sinclair. They're an independent refiner, mostly situated in the Southwest United States, and has a very large presence of retail stations. It's Sinclair, the kind of the classic DINO logo.
It's one of my favorite of the traditional oil and gas companies because I believe their mascot is a dinosaur.
Yes.
And their ticker is DINO. It's DINO.
Sinclair was actually private, but HF stands for Holly Frontier, and that was the publicly traded company that bought it. So it became HF Sinclair, took the nice, cool ticker DINO. It's a very well refiner, high returns on capital. Management has done a very good job of returning capital to investors, either by buybacks or dividends. And it's just one of those businesses that it's never going to excite anybody, but it's going to generate good returns over the long term. US Silica, they're about half oil and gas company because they sell sand as proppant for hydraulic fracking. It's a business that was very popular during the shale boom days, and then almost all of them went bankrupt because of overexpansion, but US Silica was the one who made it out alive. Their financials are markedly better than they are today, and about half of their business is selling sand as other things like pigments and filtration sand, as well as diatomaceous earth for like your pool filters. They have a large industrial segment that, anything that uses aggregates in some particular way or silicone, there's hundreds of things that it's actually used for. So stable industrial side, and with some upside on the oil and gas proppant. And then the last one is Noble Corporation, offshore rig company. I think I've mentioned them maybe once or twice before with you, Jason, but one of the reasons I find them particularly attractive is that the rates for rigs have gone up considerably in the past 12 to 18 months. And vast majority of Noble Corporation's contracts for their existing rigs are coming due in 2024. So they're going to have what's called a reprice of its assets. And when many of those rigs get repriced at new contract rates, they're probably going to be a lot more profitable than they are today. And with a business that has a very solid balance sheet and is already throwing off cash now. After those repricings happen, I could see this throwing off even more cash and being much more lucrative for its investors. So there you go. 3 ideas.
I like it. Of the three, I own some Noble Corp as well. And one of the things I like about that business versus the other two, and again, they are very different, is the trajectory for offshore does look good. The supply and demand is starting to improve and is starting to get better for the Nobles, for the drillers. Supply is getting a little tighter. The vessels that are operating tend to be higher specification than a lot of the fleet was 5 years ago, which means you can get better day rates. A lot of the projects that are being developed are in deeper water or harsher conditions where they need higher spec. Noble's really well positioned, and I like the tailwinds there. I've got one that I want to share too. You ready to hear mine?
Let's go. I was going to say, is it Trex? But I doubt it.
No, it's not Trex. I decided to stick with the energy theme. This is one of the Brookfield family of companies, and it's Brookfield Renewable. Sticking with the energy theme, this is an area of the market, yieldcos, businesses that invest in the renewable energy assets, the wind farms and the solar farms. They build them, they finance them, they invest in them, and make money on long-term contracts for the power that they produce, leveraging their access to low-cost capital, and then signing a 20-year deal on the output from these facilities and making really good money over the long term. As investors, we benefit from the dividend. They pay out the cash flows, and that's where we are rewarded as investors. Brookfield is one that has an incredibly long, successful track record of growing their payout at a higher rate than their goal, which is good. They have a modest goal that's reasonably within their ability to support over the long term, but they tend to over deliver, which I think is impressive. They've done a great job of managing their balance sheet, their investment grade. They have access to low cost capital in a couple of ways. We just saw 400 million Canadian dollar deal on some green bonds at a little over 5%. It's a lot higher than they used to be, Tyler. But if you look at their total cost of debt on their books, it's not an egregiously higher than their average. And I think that says a lot positive looking forward in their ability to continue growing their cash flows over time. The other way they have access to capital is through their sister entities. Brookfield Corporation is the parent company. Brookfield Corporation is the majority shareholder of Brookfield Asset Management, the alternative asset manager, which is continuing to see record inflows of capital. And a lot of that capital is potentially flowing into alternative assets like renewable energy. So it's another way to help fund big deals, big projects, and then Brookfield Renewable can manage those projects and also have some of its own capital invested as well. It's a great total arrangement. It's a great corporate arrangement. I think it's pretty shareholder friendly, and they have a great history of delivering. Stock's down. It's up a little bit over the past few weeks. It's peaked during the pandemic, which honestly was a juicy, bubbly peak price, but the stock price looks really reasonable. The dividend yield's close to 5%. We know they've grown that dividend very well over the long term. I think investors would do really well to make this part of their dividend growth portfolios.